Hello, and my name's Dave. Welcome to the Short Vol Show Live. And I was going to come on last night, but I got enthralled by watching the LaSalle Inungo show on YouTube. I will leave a link in the description. So I kind of held off, and by the time his show was over, it was like midnight, and I didn't quite want to start at midnight. But let me just tell you what we're going to do here. I'm going to go over my position in UVXY and how it changed over the last week. And the reason I'm doing this is not to, brag that I made money, which in this case I happen to, but a lot of times I don't, or to anything like that. The reason I'm doing this is to just kind of convey my thought process with my position, go over some of the things that I sort of think about when I'm trading, and expose people to the various aspects of managing an options position. And my hope is that not that you'll necessarily, if you're new, understand everything I'm talking about, but that it will give you some ideas of maybe what you do know about, what you don't know about, and will give us a starting point to have a discussion about risk management, positions, volatility, and this sort of thing. And my hope is that people will leave comments and questions, and we can use that as a way of, building up other content that would come out of this discussion of position management. And it's also a way of addressing what's going on in the market right now. But before that, I just want to comment briefly on LaSalle's show, and not his show actually, but the strategies that were put forth by bat scientists at the end of the show. I didn't want to hijack LaSalle's excellent show, and he's got such a wide range of knowledge of different stocks. I focus on a couple small ones, but he's got a huge amount of knowledge and an audience of a lot of people who have different skills, and it's a very interesting show, different from mine certainly. But I did want to comment for a second on this bat scientist strategy at the end of the show. Once again, I didn't want to come on there and be some know-it-all and start ripping into people there. But I did have some sort of disagreements about this strategy, which I wanted to discuss. And it's an opinion thing, and every trader does stuff differently. But I did want to push back a little bit. Bat Scientist was talking at the end of this show about a strategy, and he sort of outlined it, and maybe I outlined it incorrectly here, but let me just give it a shot. He was saying that his strategies have to do with trading either the IWM or the I think the SPY maybe. And he was saying, well, okay, I've back tested this strategy, and basically what you do is you either buy calls in one of these major indices at the low of the day, or you buy put, and conversely, when it gets to the high of the day, you buy puts. And if you hold this position overnight, then you will be profitable, or at least you will be profitable to at least 1 penny over profitability 94 to 100% of the time. And when people make claims about being profitable 90% of the time, I am immediately like, how is that possible? If you think about just mathematics and probability, if somebody could be making money 90% of the time, then that person would quite quickly take over all of the money in the world. The best traders are profitable. I would say maybe make 20% per year would be a really good goal. Obviously, some people have great years and they make 70% or even 100%. But the best traders in the world consistently make maybe 20%. And the other thing about this theory, he was saying, okay, all you have to do is buy calls at the lowest point of the day. Well, how do you figure out? How do you hit the lowest point of the day? And he gave some sort of well, I use these indicators and these averages to pick the lowest point of the day. But still, nobody is able to buy the absolute bottom and sell the absolute top pretty much ever. And the whole theory behind that was like, I've back tested that if you do buy the absolute bottom and sell the absolute top, then you'll make money. But that is very difficult to do. And so, and I think that's the crux of the matter there, is that it's very, very hard to do that. The other thing is that when you say, okay, well, I'm buying calls, and, he said, well, I'm buying calls, and maybe he gave like a time, how far to expiration these calls are, like a couple weeks or something. But the premium level in whatever calls you're talking about is important. Now, I guess if you were to say, well, by making money, what I'm saying is that the price of the call is going up. So like if I bought a call for 123, then I'm able to sell it for 124 or higher. Then in that sense, the premium level doesn't matter as much. But as far as just options theory in general, you want to be looking at which your strike selection is, I would think, would be a key to whether that was successful or not. And I really, maybe if you backtest in a certain way, you get this 90% figure, but in practice, being able to get that kind of numbers, like 90% success rate, if he was actually able to do that, he would not be on LaSalle's show, as much as I love LaSalle, at midnight on a Thursday night. He would be retired years and years ago and have a zillion dollars. So I just think that we need to be skeptical of people. And when I hear like a 90% success rate, I question it. I watch some of the best traders in the world saying, well, at least 1/3 of the time I'm wrong, and I think that's more reasonable to say. And I think the claims that when you're making a claim of a 90% or more, he was saying close to 100% success rate. I just think that is unattainable, and I would be interested in seeing the audited trading results that prove that claim, because it seems incredulous to me. Not to say that Bad Scientist isn't a very smart individual, and not to say that he doesn't put forth some excellent trading ideas. Just to say that you can get 90% success rate just seems unbelievable to me. All right, so let's move on from there. I have my little rant for the moment, and let's go on to UVXY. And like I said, I have been successful with trading UVXY over the last week, and that's great. And I wanted to talk about my positions a little bit. I did have a position where I was long a put spread, and most of it was expiring in 7 days. It was, and let's go to the charts here. And I also want to give the answer to our options quiz that we had for the last video. But let's go to the charts here for a second. So my position in UVXY was that I was long the June 14, 38.40 put vertical. And so I needed UVXY below 38, essentially. And we have had a move kind of way below 38 in the last week. The market's rallied, and UVXY has come off of these higher numbers. We can see it here coming down from 42 through the strike, that 38 strike, which is important for me to be below. I did have some stuff that was expiring today that I needed to be below the 38 strike, and that 40-38 spread got up to within 10 cents of being worth a full $2. And so I did take it off yesterday. I sold it for $188. $2 spread can at most be worth $2. So $188 was 12 cents within complete profitability, and I was willing to accept that. Obviously, we've seen it move lower today, but it could have, something could have been said, a tweet or something, and this could have been back to 42 yesterday. So I chose to lock in my profitability on that one. And I even went further to sell out the next week spread, which was the same spread, the 38.40 spread in 14th of June, which is next week. Sold that one out, and I rolled it out to a December spread. Okay, so I was able to take a $2 spread and roll it down a few strikes into a $3 spread. So each time you do the spread 10 times, instead of making $2,000, you could make $3,000. And I rolled it out to December, and I rolled it to the December 27-24 spread. So if we back up the chart a little bit to like a 1-year chart, and this is basically 7 months from now. So if you could just kind of imagine what's going to happen in the next 7 months, it seems perfectly reasonable that this thing could get down to 24. If we look at the, let's go to a 3-year chart here, and I'm just going to magnify a little bit. So if we look at the 3-year chart, we've got big swoosh down and then a big spike up, and there's been some incredible spikes. This is the so-called Volmageddon here at the beginning of the chart, and then this big move in December of last year. And it looks like we definitely have the opportunity to move lower from here. And I basically am saying that this will be $11 lower in 7 months. And so I think that's kind of a reasonable thing to strive for. And I was essentially, I had 30 of these spreads on, $2 wide, so maximum profitability of $6,000. I was able to roll it out to a $3 wide spread, so maximum profitability of $9,000 in 6 months. So just getting back to what we were talking about before of a good trader being able to make 20% in a year, this is something more around between 30 and 40% I'm looking to make in half a year. So that's certainly very aggressive to think that I could sort of double what some of the best traders think they can make consistently in a year. But compare with a lot of what's being put out there by people, it's a conservative type scenario, taking this out 6 months. Now, when I rolled the spread from the 38.40 out in June out to the December 27-24, if you look at the Greeks, all of a sudden my Greeks got cut in half. Instead of short almost 300 deltas, now I'm only short like 150 deltas, and thus I've sort of like locked in half of my short deltas here. So if it goes back up again $4, instead of like potentially losing $1,200, I only lose $600, and so I've sort of taken my risk off. And also by rolling it out, I've given myself a much longer time horizon to be right in. And so to me, it kind of makes sense that since we have had a move in my favor, and since volatility has come in a lot, that I be a little bit more risk off. And that's another reason for rolling my position here. So once again, the position now is, and I'll try to pull it up here so you can see it. I am long the December 27-24 put spread 31 times. Let me get out of the way here. Somebody was asking me last time to put up a risk to illustrate this graphically. So that's what I'm going to do. I'm going to put up the risk profile. And, pretty, this is actually is not going to be that helpful because it's just these lines are showing profitability in June of this year. So if we can try to fix this, if we go up here and we can set a date here. Let's see if I can do this right. So if I set a date of December of next year, we can look at what will happen in December, which is more important to me. But essentially, am I doing this right? Essentially, no matter which way you slice it, this is a chart where my profitability goes up as UVXY goes down, and it's just a line that moves down across the chart, so that you can see as the higher UVXY goes, the less I make or the more I lose, and as UVXY goes lower, the more I make. So I'm basically just short UVXY, sort of long term here is what this chart represents. Now I want to go back and answer that question that I had on the last video, and it was essentially this person had a position on, and his software at expiration was showing what his position was at the end of the day. Now what happens is after the end of the day, the company goes through and they process the trades, and they manually sort of expire the position. And so I had an answer on there from somebody, and I think that it was just that they didn't understand the exactly what was being shown on this screen. And I'm going to pull it up again. I know it's not really clear because it could be bigger. And I can actually let me try to make it bigger here, just so people can see this better. Let's see. Hopefully that's a little bit better. So this is this person's position right at expiration, and let me move out of the way. So that they are, the underlying went out 131.83, okay? And so they were short 200 shares, and they were long 2 in the money calls. So the 200 share, the long in the money calls are going to be automatically exercised and become the underlying. So the calls are going to turn into 200 long shares, and that's going to pair off against their 200 short shares, and the whole position is going to cancel out. The question was, how much more money are they going to lose based on these marks? And the answer is that you need to figure out how much over parity these calls got marked in this example. And so when we look on the screen, we see June 120 calls. Okay, so I'm sorry, June 129 calls. So 129 calls, so we have to figure out what is parity in the 129 calls. And it turns out if we add if we take the underlying and we subtract the 129 strike, we will get $2.83. But instead of being marked at parity, which would have been $2.83, these calls got marked at $3.20. So here, let me just circle this and make it a little simple here. Let's see. So this number here, that's the mark on the calls, right? But these calls at parity would be worth $2.83. And sorry for my terrible writing here. So if we subtract parity, which is 283 from 320, we get 37 cents, right? So 320 minus 283 is 37 cents. Okay. And there were 2 calls in this example. So these calls, if they had gone out 283, then the whole position would just cancel itself out. The short stock would match against the long stock that these calls became, and it would cancel itself out. However, since these calls got marked 30 cents over parity, the person is going to lose an additional 2 times 37 cents, which would be 74 cents, otherwise known as $74, because each call represents 100 shares of stock. So the answer in this is this person would lose an additional $74, just because these calls didn't get marked at parity. They got marked 37 cents over parity in this example. And, you know, it can be confusing because you see this position at the end of the day on expiration, and you're like, what does this really mean? Why have not my calls been exercised? Now, we know that when calls are in the money, they're an auto exercise, especially when these calls are, you know, almost $3 in the money. They're certainly going to be automatically exercised by the clearing firm. You don't have to put in anything that says, I want to exercise these calls. They're going to do that automatically for you. If you're right at the money, I would recommend in this case, the person has 200 short shares, right? So they want to exercise these calls, even if these calls are like 1 penny in the money. Like, let's say this had gone out at 129. Let's say this had gone out at 128.99. Okay, these calls weren't in the money, but since we're already short 200 shares in the position, we definitely want to exercise these calls, even if they're 1 penny away from being an exercise. So if this were to go out pinned at the 129 strike, if this had gone out like 129.99 or 128.99 or 129.01, somewhere, if it got pinned right around the 129 strike, we would want to go to our clearing firm or our brokerage and fill out a form that says, yes, I definitely want to exercise these calls, even if they're out of the money by a couple pennies or something, because I need to have 200 long shares to pair off against these 200 short shares in TLT. Otherwise, I'm going to come in the next morning on Monday, short 200 shares of TLT, and I've had that risk over the weekend thinking, oh no, what happens if this rips up over the weekend and gaps up a lot higher? So if this was pinned at the 129 strike, we would want to put a special form in that says, yes, definitely exercise these calls. The jargon would be punch the calls. I want to punch these calls no matter what, so that I can cancel out this 200 shares that I'm short here. So the answer is this position would lose an additional $74 because this amount that these calls got marked at over parity is going to disappear as these are exercised. It's going to disappear anyways because these are expired, but it's going to disappear as these are exercised. So it would have been great the thing is, if they could have at the last minute sold these calls at 320 and bought TLT paying 131.83, they could have captured that $74, but it's not clear whether someone could have actually sold these calls at 320 or not. If I was hanging out and I had time and I was watching this position, then I would probably try to offer these calls, slightly over parity. You could actually offer it as a buy rate, saying, I want to buy 200 shares and sell these calls, let's say 20 cents over parity or something, and put it in as a package deal. And maybe you could have sold this for, like I said, you could have tried to sell it 30 cents over. So you capture that $60 and you only lose 14 or something like that. But in the absence of being there and trying to just trade out of this at the last second, if this was at strike, the 129 strike, you would want to put and advise, do punch these calls. As it was $3 above the strike, they're automatically going to be exercised. And if you don't deal with them, you are going to lose that additional $74. So that's the answer on that one. And thank you for the person who put that question in, because that's an interesting thing to talk about. All right, so I'm going to leave it at that for today. It's already 22 minutes or something. Anything that you didn't understand or you want to explore further, please leave notes in the comment section, or you can reach me on Twitter. Thanks for watching today, and best of luck trading to you. We'll see what happens with the market moving forward going into the weekend. Have a great weekend, folks. Get away from your computer. Go do something else on a Saturday. Enjoy your life, and we'll come back Monday and trade again. Thanks for watching.